Good morning. We're here to start with our CEO panel. Right here on my left, you probably know all of them. To my left, it's Andreas Preuss from Deutsche Börse. Next to him, for the first time, we have Hemsley from Katz, a sign of the times, of the changing times we live in. Next to him, Katz, Romeo from Wyman, and of course, Hans-Ole. I thought that it would be interesting today when we start our debate, perhaps by looking at some of the big themes that affect the industry. We live in a time of the industry is confronting unprecedented levels of regulation. I feel I've said this for a few years in a row now. We have an ongoing crisis, and the role of exchanges as the parts of the system, the parts of market structure that do actually function, has been ever more under scrutiny. We've had some technology issues in the last year. And finally, the role of exchanges and the role of cash equity markets is having a lot of fierce debate, because as NYSE and ICE move forward with their deal, the focus on derivatives markets versus cash and the role of each is really something all of us grapple with. I thought we'd start off by talking a little bit about regulation, because that will set the framework for us. May I ask each of you, starting with you, Andreas, what is MIFIR taking away from each of you in terms of business, and what is it giving you in terms of opportunity?
Thank you, Nandini. From our point of view, MIFIR is giving quite a lot of strengthening of opportunities to our industry. We certainly believe that MIFIR is going to strengthen by means of increasing the transparency regime for specifically non-equities, and we believe that the overall financial market will benefit from that strengthening. We all are convinced that the OTC business will fundamentally be strengthened in the context of MIFIR. Deutsche Börse Group is a strong believer in a healthy balance struck between bilateral and multilateral trading, and we are friends of competition. I'm a huge fan of strong competition. We welcome the pluralism of offerings that the market continues to provide, and in that context it is clear that we all have different formats of market and or system maturity to deal with. I view that as a strong plus, and I would be surprised if the colleagues on the panel would hold very strongly different opinions.
Thank you. Mark, why don't you have a go? I mean, your business has come, I want to say from nowhere, but it hasn't become from nowhere, to become the largest pan-European exchange. You all decided last year that you all were going to go ahead and instead of being an MTF, apply for a full exchange license, and here you are today.
Thank you. I agree with Andreas. I think one of the biggest missteps in MiFID I was missing out how we manage reporting around OTC transactions, and that appears to be much strengthened in MiFID II. And I think that will improve overall price formation and actually improve volumes and liquidity overall in the market. The second area is increasing the scope in terms of instruments. Again, I agree with that point. I think as we bring in ETFs, etc., that will all point towards a much healthier ETF environment, which I think was one of the really big growth opportunities in Europe. I think the misses are, certainly from my point of view, and maybe differ from some of my colleagues, I think the consolidated tape, we're absolutely not going to see one out of MiFID II. It will be, I would think, 4 or 5 years at least until we therefore see a consolidated tape. And I also think that some of the approaches to that are being discussed to limitations on dark book trading are a little bit inefficient and ineffective. I certainly believe that whilst there are questions about dark book trading, having it on the regulated markets where there is ample supervision, monitoring, and caring about compliance, that's a good place to capture that sort of trading. And so I think that actually the MTFs and the regulated markets should be given the tools to actually capture more trading rather than have those tools removed from them. So they're the main pros and cons that I see.
Thank you. Christian.
If I may add another perspective to the same topic, I believe that on the trading side, I share most of the views of my colleagues here, but I think this is looking a little bit too far out. If we step one step back, it looks like MiFIR is a little bit of a missed opportunity to make markets better post the crisis. And this is not just about trading, it's about financing entrepreneurs, financing of companies that create jobs. I think on the listing side, the capital raising side, which was not so much the focus of the discussion of the last years. We sort of missed the chance to turn Europe, and I'm talking of all of Europe, from a continent that is mainly bank financing focused into a model that is not maybe quite like the US, but more like the US, where capital markets are the predominant source of financing. So there was an opportunity to reshape the markets on the listing side, to open up new avenues, not just for the very large cap, well-positioned companies, but for a wider range of companies and potential companies with listings all across asset classes, which was kind of missed. And I do think this is a shame. I think there's potential, there was potential, and hopefully still there is, but there's potential for tax incentives as opposed to disincentives to raise capital via issuing securities. There are plenty of forms of collateralized products, collateralized borrowing. There is a resurgence of ABS products that we in our exchange, we're trying to encourage that. This is where we think the future should be, that trying to make those listings happening. But I guess we're not representing all of the EU, so to some extent I think on the listing side we've missed a great opportunity, which we may have to wait for a few more years to fix it.
Thank you, Christian. Why don't you go ahead, John?
I agree with many of the comments that have been made. I don't think anyone would disagree. Some of these regulations are essentially coming in to try to increase competition and transparency, and it's hard to say that's not a good thing. Most of these, however, are in response to mistakes that were made earlier and trying to recorrect those, level the playing field. There's still some big questions around quite how these get implemented, the details, and quite how far they get pushed, whether it's just on the cash side, whether it pushes ultimately into derivatives and starts to change the market structure. Maybe to pick up on Christian's point, I'm not sure the regulation, or we necessarily missed an opportunity from the regulatory side to create some of those opportunities on the capital formation and improving the efficiency. I think that ball is much more in the exchanges court and rethinking some of their business model in response, partly to the regulation, but more just to the economics and the circumstances on the corporate side and among the core sell-side firms.
Thank you. Hans-Ole, why don't you wrap it up and tell us what you think?
Yeah, at least there is a risk now to repeat what has been said.
I was going to say you're not
because
allowed to agree with anyone else now.
It's difficult to disagree a lot with the other panelists. Perhaps I can disagree a little bit with John, so let's see if we can have some discussion. But let me, about the OTC, just have an angle on it, because, I mean, why do we as exchanges focus on it? I mean, there is really a good reason for that, which is related to what the topic for today is: growth. Because the problem we have today is that some volume which could provide and strengthen liquidity is not showing up there. And what is the consequence of that you do not have the liquidity really into the market? It is, of course, that the price formation is not optimal. And why is that interesting? It's interesting because if you invest in equities, who would like to have an optimal price formation? And if you are a listed company, you would also like to have the right price, especially if as many companies do, use the capital market, the exchange organized equity market to raise capital. So it is important that we make sure that we, probably with a new category, also make sure that everything is properly regulated. And I'm hopeful that that will be the outcome also of the trial. Come a little bit back to the listings, which Christian and John touched upon. I mean, it's interesting that these 46 exchanges, they in reality also operate 13 MTFs, which is organized for SME companies. And why do exchanges do that? And that's come a little bit back to John, because he claimed that exchanges don't use the opportunities. And there is, of course, a couple of reasons. One of them is that if you have an MTF, you are not forced to require international accounting standards. And what is one of the major characteristics of small cap companies? That they are local. I mean, it will not be investors in Spain who are going to invest in small cap companies in Finland, I guarantee you, okay? So why do we really require for a small cap company in Finland to follow international accounting standards if it's a domestic company with primarily local investors? But the regulation makes it possible for us to create an MTF and in reality have a listing venue also for small cap companies. And in Europe we have 13 of them. There are 1,300 listed companies on them. And I can say for my own part that yes, we have not seen many main or large cap IPOs for some time, but we have had a huge number of these small companies coming to our first North market, which we call it in our countries. So yes, there are opportunities, and I think at least my experience from being president of the organization is that exchanges in Europe are really been struggling with trying to find ways within regulation to see how are we able to accommodate development of the listing business. But again, as Christian said, we need to make sure that we do not create too much headwind also in that area.
One quick comment on that. I mean, I think that the assertion that only local investors want to invest in local companies, I think it is worth looking at that again. I think it can be true. But if you look at the US, although there is obviously single language and generally sort of obviously country-wide law, I mean, in the end, you have a small number of investors relatively who want to invest in small companies. It's just that information, whether it be information about the company itself or information when it's actually traded in terms of the distribution of market data, is available countrywide, and you can pick it up yourself over here. And so, you know, I quite happily invest in my own portfolio in Spanish companies, in Swedish companies, and I don't know everything about sort of Swedish law or Spanish corporate law. So I think there is very much a role in terms of exchanges, in terms of local markets, but I also think that we should be looking at pan-European markets. And there was a lot of buzz in Brussels the other day about a crowdfunding speech, you know, and it was mentioned last night. A lot of interest here. Actually, we've got a hell of a crowd in Europe already. They're called European retail investors. They're called European institutions, and I know it talks to the sort of model that we're going for, but I really think that if we start to open up and bring down some of the boundaries in Europe, that are in trading, that are in post-trade as well, you do start to offer a pan-European market. And if you think that all of us, or most of us, work in Europe every day, and could you honestly say you understand all elements of trading, post-trade, settlement in Europe? I certainly don't, and this is what I spend on my whole day doing. And so I think that when you start to look at US investors or Asian investors trying to come to Europe, and you start trying to explain to them, for example, the post-trade space, their eyes just glaze over. And so I think that we've got to be very conscious in Europe of, one, starting to address some of the inefficiencies that we have in the European market, but also taking into account what it looks like from outside Europe, because it's extremely confusing. And so I think that in terms of freeing up the capital market, whether it be for smaller companies, whether it be for larger companies, whether it be for different types of asset financing, reducing the complexity in Europe, reducing the frictional costs in Europe is very important.
Thank you, Mark. That's a really interesting point, and I think I'm going to follow by asking all of you, why is it that pan-European equity trading or pan-European trading in general has been left largely to the MTFs, of which Mark is no longer one? Why are exchanges not being more aggressive in pan-European trading if they're if it's all about system inefficiency and the needs of the investor? Hans-Ole, Christian, let's go with you first.
I think this is an extremely good question. Why do exchanges leave it to one exchange? And I'm happy to have Mark next to me as an exchange CEO now.
Happy to be
He's
here.
crossed to the dark side, clearly.
But I think that's a good question. Talking from a market which, we have about 16% of our companies are non-Swiss companies, so we're a very internationalized market. I think the second most internationalized, the whole of Europe, besides the London Stock Exchange Group. And yet, I think that the trading environment is more local / domestic rather than pan-European at this stage. And I believe when I look at the framework in which we operate, is for exchanges, and here I come back to the listing bit, to the capital raising bit. The exchanges trade mostly the securities listed on those exchanges. So certain companies or governments, entities, supranational entities, they issue securities that are then listed on that exchange. And these listing requirements, whether that's an equity or goes over to a bond or to an ETF, those listing requirements are very stringent. That makes a good market. And so we trade mostly those securities that are listed on our market, whereas MTFs, venues which were MTFs and then maybe become exchanges, they are trading securities that are admitted to trading, but they don't go through a listing process. They don't have to go through all this process from A to Z, the scrutiny that makes actually these securities acceptable for the general public. And I believe that this distinction, also from a regulatory point of view, has not been looked much into, but in fact, there is a big differentiation. For an exchange like us, we have very different regulation and legal obligations facing us with regard to listing, as opposed to just trading securities admitted to trading. Very different, and I believe that this is the reason why the capital raising function, the listing function, turns out to be more domestic, more know-how based to the basis that is within a certain, currently mostly country limits, whereas the admitted to trading category is something which was opened with MiFID I and which is very widely used, but it is not really the same category, the trading and the listing bit.
Thank you. John, do you want to have a stab at that?
I think it's an interesting question, Andy. If we go back, MiFID I was essentially a political decision to increase the fragmentation and the competition. And you had that dramatic shift in regulation, but also coupled with a big change in technology and rapid growth in lots of different trading models on the electronic side. And I think if we go back to that time, some of the exchanges probably underappreciated the level of threat of the new models that were emerging at the time. And I don't think responded as quickly or as nimbly as in retrospect they might have wished. But I think what the MTFs have shown is that there's not just one model for trading or one type of customer. There's value to Hans-Ole's point earlier to having one central liquidity pool, whether that's virtual or actual, I think is open to debate. But having a common liquidity pool that can be leveraged or accessed with very different market models, whether they're matching different types, different customer segments. And that's where I think some of the emergence of the new platforms have highlighted there are interesting opportunities, and it's not simply a one-size-fits-all world anymore. And that's where now trying to put the genie back in the bottle, I think, is virtually impossible. And we've seen some of that innovation. I think the exchanges can now reestablish their positioning and think more flexibly around the business models.
Thank you. Oh, did you want to go?
Yes. I think we are going to see, and we have, in my opinion, already started to see that there are no dogmatic borderlines between the different exchange models. I don't think that we continue to live in a world where established stock exchanges try to pretend nothing has changed in the last 5-6 years. And it would also be shortchanging the MTF environment, in certain cases migrating towards becoming exchanges, that they are stagnant in conducting their business. I think we see a convergence in how business is being done. It is not a static fact anymore that some of the established exchanges are actually serving as the price discovery function, and MTFs sort of behave like the parasites on the back of the cow that try to exploit that price discovery function as long as it works. Whenever a stock exchange has shown a technical outage in the past, the inexistence of price discovery function within MTFs sort of became blatantly obvious. Now, are we going to see a coexistence that is accepting that the proliferation of offerings actually is an enriching of the market? I believe yes. I think established stock exchange markets will also, to the extent they have not shown so far, have their own MTF solutions in their own park of business models. And Mark is a proof for the development that from the MTF space he is migrating into the exchange space, probably also in order to address some of the shortcomings just mentioned. An MTF in the longer run, I don't believe is going to successfully compete established stock exchanges onto their knees. If I look at Deutsche Börse Group's stock exchange business for 2012, we actually gained market share against the MTFs. We gained back 2%. I would not view that as primarily the result of us having become much smarter than we were in 2011. I view this more as the MTF space actually has not gotten a handle around how to gain more foothold, more ground in the established arena. Mark, I believe, is trying to address this through his branching out into becoming an exchange.
Thank you. I have a follow-up question, but I think, Hans-Ole, do you want to come in on that before?
Yeah, in reality, I would like to come a little bit back to this with the SMEs, because I think this is a very important element. And I think my position is a little bit that we as exchanges need to act based on the regulation we have today. I agree with Mark that there are a lot of things we can improve, so things could be better. But there are some facts we need to take into account. One of them is that most countries in Europe have different languages. So I mean, if you compare with US, please remember they have one language. I don't know how many we have in Europe, but 25 or something like that. So that is definitely something which is a differentiator we need to take into account. Another factor which I see very often being forgotten is that it's very difficult to have one definition for SMEs which works in all of Europe. Because a small company in Germany can be a very large company in Lithuania, okay? And both of these countries would like to have a well-functioning capital markets. So again, if we try to create solutions, regulations, which is one size fits all, we will run into problems. And that's why I think it is important that we try to address things with taking into account the facts. We have, for example, some years ago tried to see if we could have one MTF also offering listing services in Finland from Sweden. We were not successful with that, so we ended up also creating an MTF in Finland. And what are the main problems? One of them is that language. The other one is that if you list in another country, then you are easily catched by company law or corporate governance law in that other country. So that's another area where we still in Europe have a lot of differences which make it difficult, especially for small companies. So let us then take it one step further. I mean, we have since 2009 listed 160 small companies on this small cap exchange. 30 of them have grown and have, been able to move to the regulated market. And I think this is a little bit a proof of the concept, because we in reality have created a solution where very small companies are able on their own, based on how far they are, to be a listed company, but still learn how really to move out on a bigger market scale. And if they continue to grow more, then it could be that they would like to have a listing also in another part of the world to get even better access to capital. So I think it's very important that we try to address this based on the situation we are in, where we have to address it and not have one size fits all.
Thank you.
I think just a couple of comments back on that. I mean, I think that, as I say, it is right. There is definitely a local market. There are definitely language issues. But I think in the longer term, that's exactly what we've got to address. I receive plenty of research reports on companies that come from banks from all over Europe. And whether they be naturally a sort of Swedish-speaking or German-speaking or French-speaking, you get the common denominator, well, unfortunately or not, you get a copy in English, and they produce them in their local language. So, and certainly if you're selling into parts of Asia, again, whilst it's preferable to have them in Japanese or Chinese, there is a common set of languages, common sets of accounting rules that can be said internationally. And as I said, I invest personally in companies all over Europe without understanding local language or local finance rules. It can be done from an investment point of view. So I think there's a danger in just sort of saying this is the way it all is worked. I'm not saying it absolutely will work, but I think these things are well worth a try. And I'm actually very pleased to hear that what Andreas said is that with the country or regionally based exchanges looking more pan-European, that's a very good thing, because what they start to do is actually come up against some of the frictions that we come up against every day in terms of trying to expand our business. And I think that will in itself create more pressure for consolidation, certainly in the post-trade space in clearing and settlement, which I think is actually very, very healthy. So I think that's a good thing, because what we've got at the moment is too expensive. It's got too much friction in it, and it doesn't help the liquidity in the trading markets, whether that be primary issuance or secondary.
Thank you. We can go two ways with this. One, we can actually continue and talk about, what happens to startups, especially in the light of your comment about consolidation kind of inefficiencies. I mean, is there, does it become that a successful MTF just the next step in evolution is to become an exchange like you're becoming? Does it mean that they're sold or bought by a bigger exchange that has lost market share? Does it mean that two MTFs merge and then kind of become a larger MTF? So what happens to startups really, I thought is perhaps something we might want to talk about here. It just seems as well sometimes, Mark, that once an alternative trading system or an MTF here hits 15 to 20% market share, there seems to be some kind of ceiling. And then it's a crossroad, and then you go on to do something else. And in your case, you seem to be becoming an exchange, or you have become an exchange.
Well, we became an exchange. Really, we started off talking about MiFID. What we found was that certainly in the retail space, some of the retail brokerages just didn't have MTF in their mandate. They only have stock exchange. And then also some of the more conservative fund managers as well still don't have MTFs in their mandates. And so it was easier for us to spend 5 to 6 months changing our status than I've been working with some fund managers for over 2 years to get them to change mandates, and it's a very, very slow process. And so it's much easier for us to move to that. So you could say, is that a failure of the perception of MiFID generally in the buy side and the retail side? Possibly. But it's a fact, and that's why we do that. I think that from looking at a question from the other point of view, we've got to the #1 position in Europe, and so whilst you say if that's a ceiling, well, that's not a bad ceiling to have at the moment, and so and we're certainly looking to expand what we're doing, and there are ample opportunities. I mean, if you look at the Spanish market, for example, we're 3 to 4% of the Spanish market in November, December last year. We're 14 to 15% of that market now. And so I think there's a tremendous opportunity and tremendous demand to trade on a pan-European basis. And what that's done for us is two things. One, what we are seeing is, and to be fair, this is certainly in some of the IBEX 35 stocks, is we're seeing traders from all over Europe, from the Nordics, from Germany, from London, start to trade actively in the Spanish market because they want to. They wanted access to that market. It was too expensive or too difficult for them in many cases before. And these are guys who weren't trading through brokers, they just weren't trading that market. And then the other thing, and probably Andreas is best educated to speak to this, is that what we look at is how the cash markets interact with particularly the derivatives markets. And one of the biggest successes of the Deutsche Börse group has been the Euro stocks. Is now we're finding that another market that's really open to us is people wanted to cash hedge the whole of the Euro stocks because they can come to one place, one connection, and trade the entire Euro stocks. And so I think that as we look for those interactions of the different indices we have, the different derivatives, the convertible bond markets, and look at their interaction with the cash markets, we should really be looking at how we look at that as a continuum of instruments that are available for trading and investing, and how we facilitate the hedging, the trading that brings extra liquidity. So I think there's multiple reasons why we started off talking about the primary markets, but I think there's multiple reasons why the secondary markets model as a pan-European model is very effective. And I think that one of the things when Christian and Hans-Ole talk about the SME market, one of the things we've got to remember is that a lot of the brokers and banks and market makers who trade in the SME markets can afford to do so because they're trading in the blue chip markets. And certainly in terms of the way we're approaching things is we're encouraging our banks, brokers, market makers to move down into these lower volume stocks. And they're able to do that because the marginal cost of trading those stocks is very low for them. There are relatively few brokerage businesses around Europe that just do SMEs because they can't afford to because there's not the volume in there. We've got to find ways of creating the volume in there, creating the liquidity, and then you actually encourage some of these smaller brokers who may have better local knowledge, better language skills, better connections with local investment managers to actually invest in them. If we don't encourage liquidity in those sectors, you won't get issuance into them because the bid-offer spreads are too wide. The investors who get into them want to be able to get out at a reasonable price. They don't want to pay massive spreads or not see bids and offers in those. So these things all connect together. And so we've really got to work very hard to bring liquidity into all sectors of it and recognise the links between SMEs and the blue chips from a trading point of view. Thank you.
At this point, I think none of us have talked really about, consolidation, the outlook for consolidation, and this is as much the environment all of you live in as regulation is, a new kind of atmosphere. So why don't we have a go at talking a little bit about the outlook for consolidation in the industry, where in the same week that the Commission has cleared IZ and as we can speculate with the new name. We have Euronext, which is either going to come for an IPO or perhaps a sale. It's a great metaphor it'll be a great metaphor for a decade in the industry, because the last time they did an IPO was back in 2001 or so. Tell me, and why don't we start with you, Andreas, what do you see as the future for consolidation in this industry? I don't have to introduce Deutsche Börse's role in it.
I believe that consolidation is going to continue. It will, for the time being, be led by the United States, and the explanation of why is that so is the clearly documented over the last couple of years approach that it is much easier for US exchanges and or clearinghouses not only to set up their European exchanges and or clearinghouses than it would be for European exchanges and or clearinghouses to do the same in the United States. But it is, from a regulatory point of view, much facilitated for the US players to lead the next phase of consolidation as a result of European regulators' positions on specific aspects of the antitrust law. And I'm not going to go into the details of the past of why a envisaged merger between NYSE Euronext and Deutsche Börse Group was ultimately not agreed to by Brussels. But I'm focusing on what are the consequences of this. And the consequences of this are that in a world of global players, and admittedly we have here right now more a FESE and therefore European and pan-European view to follow, but in a world of global players being subjected to further steps of consolidation, it is almost impossible to see that Europe going forward will manage to be on equal footing with US-led exchange organizations, irrespective of whether they are primarily focused on cash markets or on cash and derivatives markets.
Thank you, Andreas. You make a great point, and can I just ask, for my curiosity, if this is indeed the case, why doesn't a deal with CME make sense for you all?
I think this topic has been very close to the heart of the broad spectrum of journalism.
I am a journalist.
And I think it makes maybe for a flickering good headlines, but mergers or merger considerations, M&A considerations are first and foremost driven by the questions, would something considered actually make strategic sense, yes or no? And there are very clear answers that Deutsche Börse Group has publicly given to this. I have nothing to add here.
Thank you. How about you, Christian?
I think I would continue from what Andreas said, which is certainly true that there are differences in the backyards of those two continents, the USA versus versus Europe. But I'm not so sure, Nandini, we are in a hugely accelerating consolidation phase. In fact, one would argue rather that we are in a deconsolidation phase, because Euronext is in fact, which was already bought, which was supposed to be a great acquisition at the time, you know, is now becoming a free entity again. And so I think it has to do with the fact that Europe is not one, or the European Union is not one harmonized economic backyard. And you can see now that we have some deconsolidation happening. The question is whether it is really necessary and beneficial to, in order to create a more open and kind of all in one flux market, whether you really need to have everything under one ownership. I give you the counter example. I think you don't necessarily have to, once you have certain critical economies of scale achieved, then you know, like New York Stock Exchange Group at some stage, by integrating Euronext, they're trying to get to the next level of economies of scale, and in fact it did not turn out to happen. So I think once you have certain economies of scale, it may be more beneficial to have an open model, whether that's an open clearing model like we have on our exchange, an open trading model like we have, an open access model. I think you can create a better market by sheer openness and market focus without having to put all venues under one certain ownership and trying to break down those regulatory national barriers which do still exist, in particular in Europe. And I think that's part of the secret, I guess, why in our home market, in Switzerland, we have an economy that's been growing year after year through this time since 2008 with a budget surplus. In the heart of the European Union, which is our largest trading partner, how is that possible? The European Union is now in its 6th quarter of recession in a row, maybe, you know, following the 7th and the quarter that we're just finishing right now. How can we be successful as a small place within that surrounding neighboring group? And the answer is an open model that allows for a superior setup to be open to immigration. We have net immigration of people, net immigration of companies. And it doesn't have to be that, you know, our infrastructure is necessarily owned by somebody else, because we think we're probably the best owners of our own infrastructure, but it's an open infrastructure and it can be successful that way. So in other words, I'm not sure, Nandini, that we'll be sitting here in 3 years and you'll have a panel of only 2 CEOs left to have the conference.
In every year that I've covered this industry, my editor said to me, "Oh, Nandini, at the end of the year, it'll be fine. You'll have no work left practically. It'll just be 1 or 2 exchanges." And so here we are, you know. In fact, the list of exchanges is growing, not diminishing, because as we see here with Mark. So do you want to have a go at the consolidation question?
Yeah, I mean, I think if you talk about the overall environment, bear in mind that there's actually a virtuous or a vicious circle here as well, is that, you know, one of the often quoted factors is looking at the US economy versus European economy. We've got GDPs that are in the same ballpark. It's just that if you look at the volume of trading in the US, it's probably 4, 5, 6 times, depending on how you measure it, what it is in Europe. And some of that is, you know, what are the reasons that might be? Some of it is frictional costs, some of it is access to going back to actually allowing a market to actually act as one market. And if you're sitting there as an exchange and you're trading 5, 6 times as more, and your trading costs can be a half or a quarter of what you're trading in Europe, and you can still be highly profitable, and that brings tremendous financial strength. You know, you look at the results of the US exchanges; they're very, very strong, given the turnover in those markets. So it's definitely another factor. So, you know, I should probably share Andreas's view for different reasons, that the US exchanges are going to be in a very strong position to be part of consolidation going forward. I think also consolidation, to be honest, is also naturally an ebb and flow. And when you have an event like MiFID I, it spawned innovation. It was something that changed the market and provided opportunities for MTFs in particular. It will just ebb and flow, though. If the markets increase, that might bring in more competition. and then they will fail, grow, or be consolidated. So I don't see it as anything particularly unusual. Although certainly we have had a very big focus across the world, sometimes on competition issues, but also in some countries there is a strong national issue, and I'm talking more probably of Asia Pacific than actually Europe or the US, but and possibly South America as well. But there has been a strong national element where you're almost dealing with the Ministry of Finance in a particular country to actually get through some of those consolidations, which make them vastly more complicated.
Actually, in that context, can I ask you all about, you're all sitting here with a unique perspective. I mean, in terms of Euronext, does it make sense for them to do an IPO, or does it make sense for them to do a trade sale?
We've offered to list them if they want to. So.
Well, that's a third alternative, and we'll all bear that one in mind.
Yeah.
Hans-Ole, what do you think?
I think it's up to one person, Mr. Jeff Sprecher, to make that decision. So I guess we can all guess on that, so time will show. But on this general consolidation theme, I think, as Mark said, the marginal cost of doing something is very small. So it's really a scale business. So it's scale business for equity trading, for derivative trading, for clearing, for settlement. So of course the financial industry, the infrastructure part of it, probably will continue to consolidate. And then of course the question is whether you are able to execute in such a way that you benefited. And I think that's the point Christian are trying to make. And I just have to say that being part of such a process, I think it is possible. I mean, if I look at what had happened with our European operations since 2008, we have been able to acquire more than 20 companies or making investment in more than 20 companies since 2008. We have been able to dramatically reduce our pricing for our customers, and we have been able to create a better return on invested capital for our shareholders. So I think, if you can do that, then I think you are on the right track. And I believe that if you execute well, you will be able to benefit from the scale there are in this infrastructure-based industry. But, time will show what will be the next step.
Thank you. At this point, I'm going to open to questions. So if any of you have questions, now's time to put your hand up. If not, I'll take the panel back and bother them some more. So you'll be helping them all if you have a question. No? Oh, okay. Patrick.
I'm just curious because
the mic is coming. 1 second.
My name is Patrick Young. Gentlemen, I'm just curious. You're talking about, first of all, I think very interesting discussion. Thank you very much. Discussing acquisitions, and I'm curious because I tend to be a deconsolidator at the moment rather than a consolidator. I think partly because I think the media have got hold of this idea that consolidation is a great story and it's driven by investment banks rather than any value add in there. I'm just curious though, because Andreas in particular, you mentioned the idea that you thought it was going to be driven from America in terms of future acquisitions. And I'm curious because I don't really see that many major properties around or assets that are going to be particularly appealing to American or other large acquirers. If you look at something like, say, a great business like the Warsaw Stock Exchange, it doesn't really add any EBITDA to you and brings 200 bodies for quite a large purchase price. I'm just curious, therefore, if you think what are the acquisition targets that might be made from America?
You go first, if you'd like.
Patrick, I would sort of give the hint that I think one should put the focus much wider than just looking at exchanges and the immediate, for example, clearing operations. I think our industry, as you probably almost better know than I, has a wide range of adjacent and not so adjacent entities in businesses that at first glance might not really have a lot to do with the business that all of us here on stage to a certain degree run. However, if you then take a second look, it makes a lot of sense to consider the respective branching out. Now, this insight into what I at high level describe does not only exist in Europe, that exists in our industry without borders. And the appetite for building portfolio in, by acquiring either fully or partially strategically attractive assets, I repeat, will be driven primarily from the United States, and that is facilitated by a regulatory reality that makes it easier for United States-based acquirers to build their business in Europe.
I think it's worth thinking around, if we move away from consolidation, just the acquisitions and a revisiting of the business model. I think there's, in many ways, an unprecedented opportunity for the exchanges. If we think of the exchanges as being market organizers or risk mitigators, but neutral third parties sitting right at the heart of the capital markets, then if you look at the customer side, some of the sell-side firms are under tremendous pressure in terms of their cost-based capital pressures. There's a lot of activities that each of them do that are undifferentiated, and many of them are really radically rethinking their cost base. The exchanges could be logical players to take on some of those services and stretch into the value chains of the sell-side firms. Equally, you could see them with that same mantle stretching into more of the data and operations, some of the technology and connectivity areas, risk and exposure management, extending those services, interdealer brokers, both for the liquidity pools in the OTC world, channeling through their clearinghouses, some of the post-trade services. So I think there's a wealth of opportunities out there on the acquisition side now to adapt the business models of the exchanges to the trends that we're seeing going forward. And that, I think, is far more compelling than some of just sort of the scale game of exchange and putting two exchanges together, which is a combination of regulation, politics, and simple maths with slightly different weights.
I think the other thing you tend to have is that an awful lot of this discussion tends to concentrate on the equities exchanges and the derivatives exchanges as we see them now. But if you look at it, look at fixed income. I mean, it's just an enormous asset class that is extremely undertraded, given the impact of it globally, given its impact on sort of funding for SMEs, which we were talking about earlier. And it's difficult. I mean, you go and look at any one of these major firms where they might have a single equity class or maybe two. They might have tens, even in some cases hundreds of bonds out there. But bringing liquidity to that market, I think, is something which will really create the debt and equity asset class on exchange. And I think exchanges could do an extremely good job of that. It's just difficult. And then if you look at foreign exchange, again, something that's very much in the eye at the moment. There are some exchange-like companies. You look at the sort of EBSs and Reuters environments. It is the only truly 24-hour asset class, and so I think that that's also a very interesting opportunity potentially for global exchanges as well. So I actually think that Andreas is maybe pointing to looking a little wider, but there are asset classes that are required by governments and corporates in the FX and the bond space that I think are completely under-traded from an exchange point of view.
Thanks. Hans-Ole?
I think it's important that we remember that we are an infrastructure business and not only in equity trading. I think it's, at least for Andreas and Christian and myself, in reality it's a small part of our business which are equity trading related. So it's much more, and I mean, just think about a couple of things. I think, as Mark have said already, I mean, we have a challenge with the CSD space in Europe. It's extremely expensive. And of course that needs to change. Unfortunately, that is one of the things I think will take time, because I've been listening to this consolidation and changing of that part of the infrastructure since '95. So I don't have patience to wait for that. So we need to see how we can do something while somebody are working with it. But this is a space where something needs to happen. EMIR will increase cost of running a clearinghouse. It's obviously that you in Europe will see consolidation in the next 3 to 5 years in the clearinghouse space in Europe. There's a lot of possibilities to move into the value chain. I think many of us do that in different ways. And again, I would just like to say that, again, scale make it possible to come up with more offerings, because your buy-in power sometimes is higher. I mean, we have found out, for example, for our part, that we are able to offer algos for our customers. If you are a smaller, mid-sized broker, then of course it's more expensive to do that on your own. But if we are able to find a solution and can provide that to smaller brokers in many countries, there's an upside. And that'll be difficult for us to do if we were not a large exchange group. So I think there's a lot of opportunities, and I think many of us are focused on that.
Maybe just to add something to that, I completely share. Our organization also thinks we have plenty of opportunities in other asset classes, in not just the fixed income space, but also the passive investment products, where we've gone now from ETFs to actively managed ETFs to ETPs. We have structured products, we have securitized structured products, and even at the end of it, we are trading mutual funds now. So we're really living up to being the investment network of choice, which is our vision. But I think while we're doing that, and I agree with Andreas, there will be lateral acquisitions in this, in the proper exchange space as it is looked at from the public side. I would really also see the world similarly to Patrick Young, meaning that I think there's not a big rush for consolidation, and in fact we are slightly deconsolidating or stopping the consolidation. And why is that? Well, we're here with the Federation of European Securities Exchanges, but so we're Western Europe mostly that we are represented. Of course we have a wider membership, but look at our market model, then you look at the US market model, and then it's not just Asia where countries are hanging on to their central market infrastructure. It's not Asia. It is Asia, it's Africa, it's Latin America, it is Canada. In other words, the only two major regions which have totally opened up to the competition in this space and fragmentation are the USA and Western Europe. The rest of the world is looking at these two regions, in particular Western Europe right now, as we are going through this regulatory and political change with MIFIR. They're looking at us and they're thinking, it's not such a great experiment they're doing there, so we're probably not going to copy what the EU did since November 2007. And I think that's the reality, that this infrastructure, and of course we're money-making companies here that we're representing, but also we have a public mandate, and that public mandate for some of us is very pan-European, for some of us is global with a national focus. But those mandates in the rest of the world are seen by politicians and market participants as being crucial, the exchange industry being still slightly different from other industries, and that makes this industry a little harder to consolidate than it would appear at first glance.
Thank you. Andreas, do you want to have a go?
Yeah, I would like to have an immediate reaction to one aspect of what Christian has just said. I don't agree with him that both Europe and the United States have, to the same degree, completely opened up. We at Deutsche Börse Group, through Eurex, for example, acquired in 2007 the International Securities Exchange in New York. Part of our acquisition considerations was a so-called westbound clearing link, and continues to be a westbound clearing link that would allow Eurex members from using their infrastructure, their trading infrastructure, to directly access the products listed for trading at the ISE. 6 years on, we are far from having a westbound clearing link. And I'm not going to go into any details here, but I conclude my statement by adding, among my peers, especially on the derivative side, there is across the Atlantic back and forth complete agreement that it is much easier for a US exchange to establish an exchange in Europe, irrespective of whether that is to be established in the UK or in continental Europe, than the other way round. And it is also much easier for a US exchange to establish an exchange in continental Europe or a clearinghouse in continental Europe or an exchange and clearinghouse in UK than it would be for any other European exchange and or clearinghouse to do the same. That is the point that I'm trying to headline or highlight again in the context or in the category of asymmetry of market accessibility.
Thank you. That seems like a great point to leave it. This is a subject that we clearly need to revisit in a year's time. So Judith, I put that for you for your agenda next year. I'd like to join you. Please join me in thanking all my panelists who were brilliant.